I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, now part of Sapiens. Release your underwriters to underwrite with the Sapiens Advantage Go underwriting workbench. Today's episode is a catch-up with two reinsurance brokers back on the podcast after an absence of over 2.5 years. That's long enough for most guests, but for an executive team that has been building out a reinsurance broking operation in earnest for only a little longer than this podcast has been in existence, it's an age. Since we last spoke, Tim Gardner, Global CEO, and Bob Bisset, CEO North America at Lockton Re, have seen the business hit profitability, witnessed revenue push through $300 million, and headcount exceed 600. What's more, in that time, reinsurance market dynamics have been transformed, and emerging technologies like AI and market phenomena such as facilitisation and portfolio solutions have broken through and rewritten business growth strategies. So we clearly had a lot to catch up about. Tim and Bob are brokers, and that makes conversations exceedingly easy to start and even easier to maintain and develop. With these two, you always end up with a little more than what you thought you were going to get when you started out. This is a high energy and fun conversation. So if you want to understand in depth the state of and prospects for the global insurance and reinsurance markets and where Lockton Re is positioning itself to serve them, listen on. I had a blast and I know you will too. Enjoy the podcast. One last point of order before we start. The first question is answered by Tim Gardner. Tim and Bob, welcome back to the Voice of Insurance.
Thanks, Mark.
Yeah,
it's good to be back.
I blink and then 2 or 3 years have passed. We're 2.5 years since you were on the show, and I found that very hard to believe. Maybe it was a time because we had a higher frequency at the beginning because I suppose there was more news because so much stuff was happening, which is great. Now that you've had at least 2.5 years or a bit longer to accumulate lots of new stories to tell me. So get me up to date, please.
Well, we've got lots of stories to tell. I mean, I think it's funny, 2.5 years ago, in many ways, feels like it was yesterday, even when we were sitting down with you. But, I think if I give you an update on our business quickly, we are broken the threshold of $300 million in revenue, which is quite a bit more than the last time we spoke. We're close to 600 people now. So I think we're about double the size of the last time when we spoke. And we've continued really on the trajectory we've been on. We've been building out geographies. So Latin America, Paris, Dubai, various pockets around the world where we see opportunities. We've made investments. We continue to invest by capability, so adding new segments into our business, so life, accident, and health, and credit, and crop, and capital markets, capital advisories, et cetera. But the thing that probably feels the best to us, honestly, is that even though the business has changed a lot by those metrics, the core is very much the same, and that's kind of what we adhere to. For us, it's about culture. It's about the long term. Our recruiting activities are still the same. We're not going to hire a big team. We want to look somebody in the eye and see that they're a fit for us and we're a fit for them and kind of build it brick by brick. So, there are more bricks now, certainly around the world, but certainly our philosophy hasn't changed.
And you're not done, I presume. You're still busy building. Is that still the story?
Absolutely. We're not saturated with any client. We're not saturated in any market. We're not saturated in any geography. So yeah, we feel like we're still very much in the early innings. Very proud of what we've accomplished to date, but still very much in build mode.
You're still at the stage where you could say some of this cost is ramp-up cost because it's not fully yielding yet. Would that be fair to say? If you've just still brought on a team and there's still some maturing to do within the capabilities that you've brought on?
Yeah, I think that's always going to be our path, to be honest. We're feeding the furnace for growth, and that means investment. I mean, the good news is financially we are profitable. We've got margins, which are certainly admirable. We're always going to continue to feed the business because growth is really the trade-off that Lockton has always prioritized. If you look at the way they built the company on the insurance brokerage side, it's really been that trade-off margin for growth. So that's the mentality of our owners. And while reinsurance is quickly accelerating from a profitability perspective, we also have all kinds of firepower to continue to invest in the business and grow it and continue to lean in.
So you're still investing, there are still new hires, there are still new territories, there's still new offices to open, and that's basically still the main takeaway for anyone listening to this.
It is, absolutely.
Have you changed in any way now that you're bigger? Have you changed in any way in sort of the sense of how you want to be perceived now that you're in the market as a 600 employee reinsurance broker as opposed to 300 employee?
The way we look at the business and the way we want to grow Lockton Re has not changed at all. We're focused on, first of all, does that person fit with us? And so, yes, we look through Are there adjacencies to add to the business now where we're core in some areas and we want to add adjacencies to it? Are there territories that we want to go into? We're going to be led to those decisions by the people that we're attracted to that we think fit our culture.
And so where are you seeing the best growth at the moment, geographically and also segmentally?
This is going to sound like a little bit of a backpatting, a little bit of a backpatting answer. But truthfully, we only have two P&Ls in the world still. I think we talked about that the last time we were with you. We've got international and North America. They're about equal in size. They're growing at about the same clip. If you go one step further and you look at the subsegments that sit below each of them, some of them are newer, so they're not as big, but it's not as though we have one capability that's the spike and generates all the revenue and the rest are these dwindling little businesses. You can go across whether it's all of our London-based specialty businesses, all really vibrant, all growing well, same in the US across segment. And that feels really good to us. You know, that was the intent. We wanted to try to create a business with the right leaders and the right value proposition so that we could meet clients where they needed us. And I think that's come to fruition. So now if they have a marine and energy opportunity, we're there. If it's a credit opportunity, we're there. If it's a regular P&C or cyber or life accident and health or capital market, you know, across the whole spectrum of capabilities, we have a vibrant business that's got tons of capabilities.
So there's not a tender that you can't enter, you'd say?
If there are, you count them on a couple of fingers now. There aren't many at all.
And as Tim said, it's how we design the business. When we looked at building the business, and I joined a little after Tim and Keith and others, but it was built on the back of, let's build a firm that can handle the most complex issues that one of our clients may bring to us. And that's invest in proprietary models, is bring in the appropriate people from an analytical standpoint. And so if we can back ourselves from an analytical standpoint and bring that firepower to a client, we know we've got the best brokers in the market and we've hired them in the segments we think that are important to our client base, then we can deliver.
What about the market itself? For the last few years, it's been providing a really nice tailwind for you. Now, is it a headwind? Is it making growth harder to come by?
Yeah, I mean, I think it is, but I think it depends on how you built your business. If you built your business to take care of accounts and grow when the market grows and grow when rate tailwinds push you forward, yeah, it's going to get hard to grow. If you built your business as a sales business where you're constantly out on the street looking for opportunities, trying to create value for clients, trying to be creative, then no. I mean, in a funny way, this last 4 or 5 months, we've seen more RFP activity than maybe we have in the history of the company. And there's probably a whole host of factors around that. But some of it, I just think, is the perspective and the spade work we've been doing up until now, gaining credibility with clients and prospects so that you have access to the opportunities, and then building internally so that you have the bandwidth to be able to tackle them. A lot of it is just those two elements coming together. So we're really excited by where we are and the growth opportunity.
And also the state of the market. Sometimes, of course, when you have a hard market, you have a lot of frustrated clients who are being told they can't buy what they used to buy and everything had to change. And we did all of that. And now we're getting to a more pliant situation where, you know, the market's much more liquid. Reinsurers probably haven't been so aggressive for 4 or 5 years. They're happy to grow, very confident coming forward. Presumably that's a good time also as a broker. You can start to fulfill a lot of this demand that has not been fulfilled in the last few years. So you have opportunity there.
No question. I think I'd also add to that, Mark, that there's a lot of capital in a lot of different forms out in the world now that clients are interested to learn about, to see how they can utilize. So it's another lens to the growth game. And we're in a period of frequency of severity. So the peril picture is pretty acute, maybe more so than it's ever been. I would think it absolutely is more so than it's ever been. So when you see across geography and across product line this severe loss potential, it does open clients' eyes to what else is out there, what am I missing, how can I think about protecting portfolios in an optimal manner.
The demand's never been more intense, I suppose.
Right. Well, you know, what's really interesting is if you tracked the RFP activity over the last, 5 years, there probably hasn't been a huge disparity in terms of number of RFPs we've been invited to, although it feels like a bit of a spike now. But what's interesting about right now is that post 1/1/23, loads of property RFPs, right? Because clients are concerned about the hardening market. Are they getting the right advice from their current broker? Are they approaching the market in the right way? Then the specialty losses come. What happens? Loads of M&E and loads of specialty RFPs. Now, as Tim was kind of referring to, it's really diverse, right? So I think we've got 15 RFPs on the go now. We've got them across the US. We've got a couple in Latin America. We've got property, casualty. Our capital markets team is juggling 4 RFPs now, along with our capital advisory. So it's much more spread than we've seen over the last 5 years.
Wow. And what do you think is driving that? I mean, why do you think they all come to market at the same time?
Great question. And we've been really trying to dig into this a bit. And I think it comes back to right now, yes, it's a softening market. And clients want to make sure that they're getting the proper advice in this market. Is it an element?
You don't want to miss out on anything.
Yeah, and I think yes, because you know what, it's as Tim referred to, there's additional capital in the market coming from all different angles. But clients looking for, am I getting the right advice in terms of the structuring? Are there lines of business that we should be combining together? Are there marketing avenues that we're not pursuing that we should be? So it's really in the round, they're questioning, okay, are we buying the right product for the
I suppose
period
it's
right
just
now?
more possibilities than there were, so therefore there are more permutations and combinations to explore.
100%, yeah.
Actually, you mentioned about alternative capital, there being a lot of it, and perhaps to a greater degree and with a greater appetite than it's had for quite a while. How would you describe the state of that alternative capital market? I'm kind of framing this question more from casting our minds back to, say, about 2013, 2014, when there was a big ILS boom. And by 2015, 16, it started to make a real impact. And I remember as a journalist then writing about the sort of innate fear within the traditional market that they might be becoming slightly less relevant and or losing control of the market. And this was a destabilizing force. And perhaps with hindsight, some of that capital was slightly destabilizing by the time the big losses came in. Some of it was shown to be less sophisticated than others. And like it always is, every time you have big losses, this always happens. But now that we're having a resurgent ILS market, some of those traditionalists might say, oh no, here we go again. What would you say to them?
Yeah, I mean, I think there's less fear about the pertinence or the value of ILS, I guess. I don't know that that's where the fear would come from. I think it does surface from pricing pressure. And if you think about, if we just use property cat for an instant, the retentions really haven't moved since 2023. We're not seeing a drop down in retention levels. But what has happened is you've gotten squeezed from the top by ILS and you've got squeezed on the side from third-party capital that's coming and is writing quota shares and sidecars, et cetera. So demand has really been impacted by these two alternative capital sources coming in and taking capacity. And we know our market is driven by supply demand. So, as you think about why is the market fallen so precipitously in cat, that's part of the equation is its supply has grown because retained earnings, et cetera, additional capital that can be brought to bear. And demand really hasn't grown in the main, but it's also been curtailed by these two other capital sources.
And I just add into that.
Yeah.
You mentioned the sophistication of the capital sources. They understand our business really, really well. So not only are they taking Tim's property cat example, but they're coming into specialty and casualty quota shares, which is, I know, is dominating the headlines. And they're also sitting behind syndicates. So not only are we seeing them in the cat bond space and quota shares from a short tail perspective, but they are very active in some of the areas where if you asked us 15 years ago, they weren't going to come into.
And are they more sophisticated? Would that be fair to say?
Absolutely. Absolutely. They are spending the time to get to know our business and they are looking for these alternative asset plays. So they're making the right investment and they are asking the right questions.
Something like a softer market or more pliant market for getting away those ideas that during a hard market, everyone's far too busy just doing the day job, just getting stuff done, trying to complete programs and service clients in the most basic form. When the market gets a bit more pliant, then you're more likely to have the door open to you if you've got a good idea. So it's a good time for good ideas. What kind of good ideas, good innovations are you most excited about within the reinsurance space, and what were you allocating most resources to and thinking, you know what, this is the time when this is really going to take off?
I don't know that you can point to any prioritized list of this is what clients are pursuing. It's so client dependent, geographically dependent, line of business dependent. So I guess I would answer that with a broader, you're absolutely right. This market provides for a lot of opportunity to innovate, but you've got to start with a blank sheet of paper with every client. What's their problem? What's their market position? What are they solving for? How do you think about solutions and counterparties? That work doesn't change, but it's exciting because if you do have the breadth to be able to have multiple conversations with clients because you've built capabilities across the spectrum of the business, then there's a lot of them. And that's sort of what we're seeing is the opportunity set that's surfacing for us is emanating from a bunch of different places because those conversations are happening all over.
When I talk to reinsurers, and to a certain extent, some of them have had a bit of a negative shock in that they were expecting the market to soften, but they weren't expecting it to soften as much as it has, as fast as it has. And nobody likes negative surprises. Have you noticed if they've had this negative surprise, has that changed their attitudes? Have the more, let's say, the more prudent ones, has that changed their attitude to the market in terms of their risk appetite at all? Has it translated into, you know what, now the market isn't quite as good as I thought it was going to be, or quite a lot worse than I thought it was going to be? Is that now translating to different behavior, to say that they're putting in their horns a bit?
I don't think so. I would say that the reinsurers, how they're changing their tack is they all formed this, I would say, target client initiative a number of years ago. So it feels like they're doubling down on that initiative, trying to get closer to the client to make sure that if an insurance company is buying less reinsurance, that they are close to the client as possible so they don't lose out on their share. But the reality is supply continues to outstrip demand. So their desire to write business isn't waning at all.
Yeah, I was going to add to that. 2026 is a good time to be a reinsurance buyer. You can get a lot done. Prices are still soft and softening. And I think the combination of steeper rate decline than anticipated and signings that have been challenged through the year, some reinsurers have holes in their budgets that they're trying to make up for. Now, how long that continues is probably the question, right? What happens at 1/1/27, that might be a stickier renewal period because the book still, you talk to most reinsurers, they feel like there's still profit in their portfolios, but it's getting thinner. So what happens when we go another year? If we don't have a heavy cat season, get through to 1/1, clients would be expecting additional rate declines. And I think 27 is going to be a far more interesting conversation to that end.
So they're still reasonably happy with the adequacy that they've got, but they're obviously less happy than they were 12 months ago.
Yeah, right.
Because of that, we've seen a bit of carrier consolidation. Obviously, this is what often happens. If you can't see organic growth, might be harder to come by. Obviously, if you're going to get signed down worse than you thought you were as well on the things you have managed to write, we've seen a bit of consolidation. Do you think we're going to see more?
Yeah, we do. I mean, I think it's the cycle we're in. This is the stage of the market where growth is going to be hard to come by. And I think the bigger balance sheets are going to have more leverage. They're going to have more pricing power to the extent it exists. They're going to have more signing capability. So we certainly expect consolidation to continue.
I think the interesting thing on consolidation is that the big consolidations we've seen so far have not taken any reinsurance capacity out of the market. So that's just going to continue to fuel more M&A activity as we go forward.
What about MGAs? We've had a really kind of golden era of MGA formation and that sector that has been facilitating the capital provision to those MGAs via all sorts of different conduits, and often with a reinsurance balance sheet somewhere behind, have been doing extremely well. And we've had fantastic growth in that segment. Now that the market's changing, what do you expect to happen? Because, of course, they could go different ways. And often, if someone comes with a good story when the market's softer, then it might mean that actually more MGAs get back than would otherwise have been the case. Or it could equally be, actually, you know what, we're going to become more risk off. What do you think is going to happen? Because we're talking about multi-billion capital movement.
Yeah, I think if you go back 15, 20 years ago, and when we talked about MGAs, they were really wheels and comp. Was sort of the backstop of the MGA world. That's not the world we're in today. Virtually every line of business, there's MGA capability. And I always think if you have an underwriter that has, or an underwriting team that has a compelling value proposition, they're going to absolutely be able to build it out through an MGA lens. I think what will change through market cycles, though, is how they're getting support and where they're getting support. So does delegated authority from carrier partners start to wane as results get more challenging? Of course it does, right? That's the natural market cycle. Does reinsurance support behind front start to get more challenging if results deteriorate? Of course it does too, but that doesn't mean they go away. And I think the trend in the industry around the validity and sustainability and breadth of MGAs, that continues. How often they launch and how you build support behind them is probably going to be the bit that changes. But we really believe in it. We've made a lot of investment in both the US and over here in London with binder capabilities to be able to address that market because we think it's got real sustainability.
Yeah. And ultimately, I suppose anything that is not making money is just not sustainable. So the ones that are will always get support because they're good. As the market gets more challenging, it's Darwinian in that sense, isn't it? That good ones always survive.
That's right. I think you have to start with the idea of, as you're evaluating, even if you're a broker, you've got to evaluate the validity of the offering. Is it compelling? Is there something here?
Because it's an investment on your part, isn't it?
It is. So, and it's not hard for us to be able to analyze and say, we think this is a viable business. They've got a track record. They've got history. They've got support. So you can certainly audit the capabilities
I
before
suppose
you
you
launch
almost
it.
have to because there's so many opportunities. There's only so many you can service.
Yeah,
Absolutely.
And you want to pick the best ones.
Opportunity cost, absolutely.
Something else that seems a really interesting opportunity, it was around when we last spoke, but it's really emerged because I've had people on the podcast in portfolio solutions underwriting. Now, particularly in the London market, it's really emerged. But obviously, whatever happens in the London market is going to be done everywhere else over the next few years, one would imagine. There's no impediment for it not happening elsewhere. We're talking about multi-billion dollars now of the London market premium base being transacted in this way. What about you guys? I mean, you've built an entrepreneurial reinsurance broker with not too much tech debt of your own because you're quite new. How do you view this and how are you going about being the reinsurance broker for this new phenomenon?
Again, I guess I'd start with the notion that do we think that the industry is going to trade more in a facilitized manner 2 years from now than it does today? Of course we do. Do we think it continues 2 years on from then? Yeah, it does. So I think that there is absolutely a direction to travel where policy by policy trading in the insurance business is going to be slowly, quickly augmented by portfolio capability. The question is how, right? And what's the best way to do it? And we're pretty heavily in that space today. To date, we've done it with the lens of where do our clients need capacity or unique capabilities? We'll build a facility to support that. What we haven't done is some of the bigger multi-line, multi-geography, big London-based platforms. And the reason is we start with the premise of, is it good for clients? Not just broker enhancement, broker commission increase, but is it actually good for clients? And we're not a huge believer that you can carve out a point of commission and seed that back to clients and call it good for clients, right? I think at the end of the day, they're good for brokers. And by the way, not knocking them, good for them. If that's another broker strategy, that's theirs. But one of the pieces that Ron Lockton has made sure we're constantly focused on is show me directly where this starts with client value, and then we'll go forward and try to build something. So I think they're going to continue, Mark. I mean, if you think about the combination of technology, we've all got much better data, the ability to underwrite on more of an algorithmic basis so we can understand profitability better, the ability to trade through these platforms, they're getting more advanced. So it's not a trend that's going away. And it's just a function of how do you make it fit for you?
Yeah, over time, as your technology is so much more keeping up with the latest technological trends, you're able to really see your book, those billions of dollars of premium that you're now moving around the marketplace of reinsurance premiums. And again, something that's becoming globally diversified and by line and by geography. Again, there's a potential there as you grow to facilitize some of that, to say, right, you know, this could be very attractive for somebody to write a proportion of our business in that way.
Yeah, and I'm actually referring to insurance premium.
Yeah, no, absolutely.
Too.
But it
so
could
yes,
be
reinsurance
it could also
as well.
be reinsurance as
100%
well.
could.
Yeah.
But one of the interesting pieces that we're lined up with now is reinsurance capabilities being brought to insurance portfolios.
Yeah.
So the combination inside of Lockton, just as one example, we're really well tied when we speak to facility creation on the insurance side, because the skill set is really a reinsurance one. It's
Yes.
portfolio modeling, it's portfolio trading, it's the DNA of our business.
Yeah, it's a reinsurance skill, isn't it?
It is. So being able to have the internal capabilities to mesh those two so that you can present yourself to the market in a way that is most compelling is really valuable. And that's something we've worked hard to stitch together.
Yes, because when you said at the beginning about it being a big binder broker, that's kind of what you are. Again, and there's an opportunity there for placing other people's facilities in that sense, I would presume, as everybody to a greater or lesser extent facilitizes a percentage of their book, then the reinsurance broker could be a fantastic conduit for getting that done for you, placing those facilities.
Yeah, no question.
Yes.
Yeah. We'll see how this goes, but it's still kind of early days yet.
And I think it's going to be one of the most exciting pieces of our market over the next 5 years. The trends are undeniable. And I would argue that some of the bigger structures that have been created are going to come under some duress. So what happens next? How does the world then pivot, and how do we react, and how do you build facilities that are right for you? Because every broker is going to have a different flavor.
What do you think from a philosophical question, again, changing the way the market's dynamics work, in that, particularly for some of the brokers, when I talk to them on the insurance side, they'll say, well, actually, we can't really blow up these facilities because they're becoming too fundamentally important to us. They are good for brokers and they're obviously good for our clients. So we don't want to have to go to our clients and say, hey, you know that thing that placed automatically 20% of all the business you send to us? Oh, sorry, guys, that's not there anymore because it had such bad results that no one's supporting it anymore. Actually, they've built their business model around having that as this pillar of their business. So do you think obviously that will stop the market softening to the point of unprofitability or staying too unprofitable for too long. Do you think it will instill more backbone in the market because there's more incentive for the market not to be unprofitable?
I mean, it's a great question. I don't think we know the answer to it yet, to be honest. I don't think we take the view that they're too big to fail.
I mean, ultimately, we have stock market cycles. Insurers have lost money for centuries, and they've never had an incentive to lose money, but it still happened anyway. So we'll see.
We'll see.
But I mean, to put a point on your comment, if you think about the intersection of AI and big data, you're right there in the facilities. So as we find better ways to use the AI across the data that we have in the putting of these facilities, it'll be tougher to hide when there's poor results.
Let's talk about AI, because when we last spoke, I'm sure we had probably asked you about, hey, what do you think about AI? Well, it was just before it really exploded. Anyway, a couple of years ago, I could ask everybody, what are you going to be doing about AI? And people say, well, we're going to be experimenting with certain things. Now we can move on to, well, you have been experimenting with AI probably for the last couple of years. The question really now is what's really worked? From a reinsurance perspective, what's been the best?
Yeah, the things that have really worked for us are supporting our analytics teams. So curve fitting, experience and exposure modeling, loading all of that material up into our stochastic modeling tools. That's the kind of stuff that you can automate. So what it's allowed us to do is take the actuaries that had been spending a lot of their time in, call it lower value added model building, and now they're interpreting the models and talking to clients about them. So that curve has accelerated our ability to be more proactive and more value-based in the analytics side. And that's really tip of the iceberg type stuff.
So you can come with 5 options, whereas before we've only had time to do 2.
Exactly.
Yeah.
Or you can stress test portfolios. You can run multiple portfolios, all of that work. And then you have things that sound simple, but they actually save a lot of time as well. Create wordings. You're no longer going through a library of wordings clauses. You can speak into an AI support tool and you can build out a contract in no time at all. So what we've done with AI to date is point it at specific tasks, which in and of themselves might not be all that meaningful. But when you couple it across 25 tasks across all of our business, they're real time savers and dramatic improvements in how much we can spend more time on more important things with clients.
I was thinking, a lot of people told me on the insurance side, of course, that claims, big deal. But of course, claims on the reinsurance side can be just as complicated, particularly it's some aggregate thing
absolutely.
that's in excess of 5 million for any one event, and then it accumulates over a year. You think that could be quite complicated. And you could go into a lot of detail on that, and it would give a lot of projections about whether this thing's actually going to pay a claim or not as you go along. And it seems like the applications are almost endless.
We'll take advantage anytime we can use a product or use AI to free up some of our best educated people to be able to think more creatively. We'll take advantage of that.
What about the pitch to talent? Now that you're bigger, 600 of you, has the pitch changed at all? I remember when we last spoke, I think it was probably you, Bob. So I think you were more for the metaphors. We were taking people saying, hey, try this new food.
Yeah.
It was the leap of faith. And then by the time we last spoke, it was like, hey, we can say that the meal is absolutely delicious. Come and enjoy this fantastic banquet that we're putting on for you. What is it now? Has it moved on? Because presumably if someone comes to join you now, they're not taking as much of a risk as they would have been when they were employee under 100. And now they're being an employee with more than 600. So just in that pure sense, are they taking as big a risk? And also for them, is the opportunity as big as it was?
Are you calling us part of the stodgy establishment, Mark?
Well, I don't think you're stodgy at all. Absolutely not. Sitting here, there's no way, looking at you, no way you don't look stodgy. But are you stodgier than you were? Yes. Maybe you're less risky and a real entrepreneurial character. Do you think they might look elsewhere now because they want that high octane sort of ride to say, where's the biggest opportunity?
Yeah, I'll jump first while Bobby thinks of the metaphor that's going to put a bow on it. But no, I don't think so at all. I mean, I think we are very much still in the same school we've been in, which is we're in full growth mode. We're still trying to be as entrepreneurial as we can.
And I suppose in the grandest scheme of things, you're much bigger than you were, but you're still small.
Yeah, of course we are, right? And we still have all the same appetites. We still have all the same investment opportunities and capabilities. We still have the ability to allow entrepreneurs to come and build businesses and build segments and build out geographies, et cetera. So I think the message actually resonates more because it's that question of I can join the firm where I continue to be entrepreneurial and I get support to really drive and grow a business, but they have a bunch of stuff. But now they've got all the tools that allow me to go do it. So you don't have to create everything from whole cloth. You walk into more of a turnkey capability, but still the ethos is there of very much forward-leaning and entrepreneurial minded.
So yeah, they've got better support. I suppose you call it the best of both worlds a little bit, that you've still got tons of opportunity, but you do have better resources. So you know that you've got the chance of actually succeeding without having to do it all yourself.
Absolutely. And we're finding our best marketing tools are the clients and reinsurers. So it's the clients and the reinsurers that are talking about our dynamic culture, how we're approaching the business, how we're trying to differentiate ourselves from our competitors. So for us, yeah, I think I agree with Tim that we're offering the same meal, the same ingredients that we were 5 years ago, 4 years ago, 3 years ago. But now it's a proven result. People know what it's going to taste like when they come here. They know what the experience they're going to have, and they want to be part of it.
Opening new franchises near you. So yeah.
Yeah, absolutely. Absolutely.
One more thing I wanted to ask about AI. What do you think is going to happen to the average daily life of your average reinsurance broker in 5 years' time, perhaps, because of AI?
I'm very optimistic about where we are in 5 years, because if you think about the day-to-day job of a reinsurance broker, you can get caught up in some of the mundane stuff, and it needs to be done. The basics need to be taken care of. The fundamentals need to be locked down. But to have that time to be a little bit more creative, think about your client more, read your client's balance sheet, understand where they're trying to go. More time to do that. I think that only makes the whole experience better for you and for the client.
I'll throw out another one, Mark. I think about the advancement of our business has kind of gone in steps in my mind. And if you go back to a long time ago when Bob and I started in this business, we were really about the transaction was the value we delivered. And it was about your marketing capability and your leverage in the market and all that. And then it matured over time to be more about the analytics of a portfolio. So we take the specific portfolio, we can model it, we can tell you about the volatility, how best to trade it. And I think where we're headed is now the ability with more data and with AI capabilities to look at the holistic business. What businesses aren't you in that you should be? What segments aren't you in that you should be? And if you think about the treasure trove of data we have inside of a Lockton, both with insurance and reinsurance premium and claims and policy information, to be able to use AI tools to go to a client and say, you're not in the US middle market business, but you should be. And here's what it would look like if you wrote a portfolio of X size. And here's how you go about finding it. In other words, here's who you work with to go build that portfolio. Here's the volatility that adds to your business. Here's the execution risk attached to it. Here's the product set you need to be relevant. All of that is in front of us. So I think it's going to allow us to wear an even more dramatic consultancy hat, because we're going to be able to think at a broader portfolio level, capital level, full enterprise value deliverable. And I think that's the big race, is to try to get to how do you get data in a way that it can all be used and pointed back to clients so that it can be the most valuable.
And then there's that virtual sort of growth wheel comes out of that, doesn't it? Because of course, the bigger you get, the bigger your ability to grow, because you have more data, you have more insight.
Yep.
Yes.
I think I've come to the end of all my questions. Is there anything you want to add before we sign off? Oh, but I should ask you, Bob, your job title's changing. Are you moving over to the States?
I am. Yes. So going to move my family over to the US this summer.
Good luck. And where are you going to go to?
We haven't decided yet. We've got to do a little
somewhere
run
in the
around
middle
this summer. Yeah,
with a good
exactly.
airport.
No, it'll be the Northeast. So I spent a lot of time. The job started in February, which was great because we run a May to May fiscal year. So it gave me time to see our fiscal year 26 close out and then get the budget ready for fiscal year 27. But it also gave me a really good chance to understand the gravitational pull of where I think I'll spend my time. And it certainly came to a realization to me that New York was going to be where I should be spending my time. So it'll be figuring out where the best place is to put the family around that New York area, whether it's New Jersey, New York, or Connecticut.
And London to New York isn't so hard, I think, because there's so many similarities, I think, and there's big
Absolutely.
cities with big financial markets and kind of that kind of thing.
Yeah, actually, that's a good kind of metaphor to the role that I'm taking on. I'm lucky because there's no issues with our U.S. business. It's an opportunity or an inflection point in our business that I was able to take over from Nick Durant, who's done a fantastic job, and just try and bring some of the skill sets and some of the experiences I've had to our U.S. business and just be part of the growth story that it's been for the last 6-7 years.
Otherwise, anything else?
No, just to thank you, Mark.
Yeah, thanks.
Really good to see you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry.
The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.